Thanks for joining the second video of our real estate investor series. In this video, we'll talk about few real estate terminologies which will be used a lot in our real estate analysis. So the main thing we want to talk about the types of rental properties and mortgages. So there are mainly two types of rental properties. One is residential, another one is commercial. So what are those types of property? So mainly the residential properties include the single family house, duplex, or any unit from 1 to 4. And in case of commercial, more than 4 unit properties are considered as commercial properties. So what type of mortgage you can get for both type of properties? So normally for residential mortgage, you can get residential loan, mainly the 30-year fixed or adjustable rate mortgage. Only catch is that you can get only 10 residential mortgages per borrower. For the case of commercial mortgage, you will get commercial loan and there is no limit as long as the income is sufficient for those from those properties. And how can you qualify for the residential and commercial loan? So for the case of residential, you need a decent income, normally W2 income or self-employment, and DTI should be less than 50 based on lender. It might be different for other lenders. Maybe sometimes it could be 46 or 43. DTI means debt to income ratio. And for the case of commercial mortgage, it mainly depends on the experience and also DSCR, which needs to be below certain threshold. And what are the advantages of residential mortgage? The residential mortgage is easy to qualify. You need to pay less down payment options, and typically the rate is very low. Right now it is around 3 or a little bit less than 3. For the case of commercial, the main advantage is that the non-recourse option available. The non-recourse means actually it doesn't go to the credit report of the personal borrower. And sometimes you get 30 years amortization and you can get actually high loan amount, which is not sometimes available for residential mortgage. And what are the main disadvantages? So for the case of residential, it's based on the borrower credit worthiness. That means actually you need to have a high credit score to get a high amount of loan and also low rate. And it's full recourse. That means the borrower is personally liable for the loan. So if you default on the loan, actually it goes to your credit report. For the case of commercial, the rate is typically high, around 5 to 6%. And typically there is a 5 years balloon payment, and LTV is low. LTV is loan to value. Normally you need more down payment for commercial loan. So few other terminologies we'll talk about in this video so that actually we know what we are talking about. So first thing, we want to talk about purchase price. The purchase price is the price which is a contract between the buyer and the seller. Sometimes it also called a sale price. The closing cost. So whenever you apply for a loan, these include the mortgage origination fee, title insurance, some prepaid items. It actually is a good indicator to compare different types of lenders. And what is interest rate? So rate at which principal and interest will be paid. So normally for the case of 30-year fixed, if it is 3%, then you need to pay the loan as 3% interest rate. And there is one more interesting terminology, that is APR, annual percentage rate. So the problem is that in case of different lenders charges different rate or actually closing cost. For example, you can consider the mortgage origination fee or discount points. So if one lender charges more closing cost or actually origination fee, that means the APR would be higher. So if the APR is high, that means the actual payment you need to make, that might be higher. Next, we will talk about ARM. So it's called ARM also. The main definition of these is called adjustable rate mortgage. Sometimes you will hear that actually 5/1 ARM or 7/1 ARMs. So it's means that actually if it is 5/1 ARMs, the rate of the mortgage will be fixed for 5 years. And then actually it will change based on some prime index. So if you move around a lot, then actually it might be your friend. That means you don't care about actually if it changes after 5 years, if you only live less than 5 years in a house. Then ROI means return on investment, mainly used for cash purchases. So if we invest in rental properties, we want to find out actually how much return we are getting based on our investment amount. Sometimes it's similar to cap rate, we'll talk about in the later video. And COC, that is called cash on cash return. So whenever you get a loan or mortgage for a property, then you need to put some sort of down payment, 20 to 25%. So since you are not actually paying all amount by cash, you want to consider actually how much down payment and also closing cost you are paying. So in that case, actually you want to find out what would be the cash on cash return. For example, you are buying a 100,000 property, 100,000 purchase price, and you are putting only 20,000 down payment, and maybe your closing cost is 5,000. In that case, total expense you are paying, that is actually 25,000, 20,000 down payment and 5,000 closing cost. So you want to calculate the return based on 25,000, not the actual price, since you didn't pay the whole 100,000 for the property. Let's look at the sample mortgage document. So this is the sample mortgage document I got for one of my property. So here you can see that actually the loan amount is 79,500. The interest rate is 3%. And this monthly principal interest, that means how much you will pay for the monthly principal and also the interest. And it will tell you actually, is there any balloon payment or prepayment penalty? For both of the cases, it's no. And there is one more thing, actually, you need to consider the estimated escrow. So escrow, sometimes actually the lender want to set aside the money for tax and insurance in a separate account, which is called escrow account. And estimated taxes and insurance is $299. So in total, in each month, you need to pay $634, where you are getting loan for $79,500 at the interest rate of 3%. And there will be some closing cost, that's $7,045. And in the next page, you will be able to see that actually what are the mortgage origination charges. So the lender is charging 3.678% of loan amount. That means $2,924. And there is also an application fee. So this is the loan cost. And there are a few other charges you need to pay: appraisal fee, credit report, or tax service fee. And sometimes actually the lender will require lender's title insurance, which is also requires some fee. So in this mortgage document, you will be able to see the total cost of the loan, and the total loan, if you go to the right side, that loan amount is 79,500, and total closing cost is 7,045. And estimated cash to close, it might be from the borrower. That means how much money you need to bring to the closing. So 1,433, but it's actually to borrower. That means actually the borrower will get paid 1,433. In the next page, you'll be able to find out that if you want to compare the different mortgages, so there'll be one option that actually in 5 years, how much money you are paying and what would be the APR. So although in the previous page, we saw that the mortgage rate is 3%, the APR is 3.418%. Because different lenders charge different origination fee or other fees, this APR will be different, although different lenders might have same 3% rate. So you want to consider actually which APR is less than the other lender. So you want to go with the lowest annual percentage rate of the lenders. That's all for this video. Thanks again for joining here. I hope you guys learned something new. See you in the next one.